Welcome back, investors, to Ticker Time News. I'm Adam, and today's trade started off on a downbeat note, and it surely ended on a downbeat note too, if you were trying to find a bounce. If you sold into strength and shorted the way down, well, then it wasn't that bad of a day. Ultimately, it was just another choppy session in this market, as financial stability concerns came back to the forefront. Oh boy, the Bank of England, it's making a mess. Yes, it is. Now, along the way, on today's choppiness, the S&P 500 did set a new intraday low for the year at 3568. And as you can see, bottom right-hand corner of the screen, we closed at 3588. That's only 3 points above the low of 2022, which was set back here on September the 30th at 3585. So yeah, 3 points. Could we find it tomorrow? We most certainly can. Now, that low for today, that low came shortly after the open. Let me switch to the 5-minute chart here. Hold on. It's going to look a little weird. I got to click a special little button here to smooth this out. And there we go. We have yesterday and today, 5-minute chart for both days. What happened yesterday? We started going down in the morning, mid-afternoon, we turned it around. It was a choppy session. This morning, though, we gapped down, then rallied, then kind of sold off, and then we really sold off. So again, what was it? Another choppy session of up and down and up and down. That is going to only increase as we continue moving forward in this week. This week is packed full on the tail end of it. Yesterday, today, really some overseas concerns about global growth and global financial stability, but we haven't really gotten anything at home yet. But don't worry, that's coming tomorrow and Thursday and on Friday. Big end of the week. So expect volatility to kick it up a notch as we move forward in this week. Now, this did stoke renewed buying interest today, that carried the S&P 500 from this low set early this morning of 3568, and let's just open it up to just today, all the way to a high later in the day of 3640. That was the high for today, which came just after the lunchtime hour on the East Coast. Now, the opening selling interest, that stemmed from growth concerns and worries about financial stability. The afternoon sell-off, though, that was squarely on the Bank of England. Yes, they're back in the news again. Bank of England. It was intervening yet again in the UK gilt market. And remember, the UK's gilt, it's G-I-L-T, gilt market. I know it sounds like I'm saying guilt, but no, gilt. I think I'm pronouncing it right. I guess I could be a little off. But anyways, their gilt market is just like our bond market here in the US. So with the UK gilt market, it had a nasty sell-off that happened yesterday. And that completely undid the gains registered after the Bank of England announced its emergency gilt purchase operation all the way back on September the 28th. Can you imagine if our central bank stepped in to buy bonds? Oh, isn't that called quantitative easing? Yeah, something like that, right? Well, we're in quantitative tightening over here in the US, while the guys in the UK, they're doing it a little bit different. So today, the Bank of England said that it's going to buy linked or index-linked gilt from October the 11th until October the 14th to medicate. It's one of the two, right? To mitigate the dysfunction in the market and try to prevent a fire sale from taking shape over there. Because if that happens, man, markets go down quick when that occurs. Now, the slowdown concerns came in light after the IMF, and this is big news. And this is another reason why we had this huge sell-off in the afternoon. But the IMF cut its 2022 forecast to 2.7% from 2.9%. So it dropped it down a few tenths of a percent and said, and this is the worst part of it, and said the worst is yet to come. Didn't we say something like that on yesterday's live stream? The worst is yet to come. Oh, yeah, Jamie Dimon, the CEO of JP Morgan Chase. He did an interview yesterday with CNBC, and he said we have another 20% to drop. And that 20% is going to be a lot more painful than the 20% or nearly 25 to 30% that we've seen so far in the big indices. Now, we looked at yesterday. I'm going to go back to the daily chart here. We looked at yesterday where another 20% drop would take us. And, right now, it looks like we are in striking distance of the 50% retracement, or about 3,500, which is right here. The weekly expected move is 35.15. We're getting closer and closer and closer to that mark. It's only a matter of time before we tag it. Is it going to happen this week? Well, if inflation is hotter than expected, yes, absolutely. We could actually cut right through it like butter, hot knife through butter. Yeah, that could occur very, very easily. Inflation high, and boom, we're down there. Okay. So with that said, Jamie Dimon and now the IMF are all both saying that the worst is yet to come. More pain to be expected. And as long as you know how to play these markets right, you can make a lot of money, even when the market's going down. There are simple ETFs or ETNs, whichever you would like to call them, like SPXS. For example, if the S&P 500 is going down, you buy it just like you're buying an ETF. And when the S&P 500 goes down, you are making gains in your trade there. So there are ways to do it without having to jump into options, which I know confuses all of us when we first get started trying to figure out how options work. And that's why it is always best, as I was reminded yesterday, to paper trade to get a feel for how this market and this choppiness can chew you up and spit you out. Or better yet, turn some money into gains while the market is going down. All right. Now, there was also reports that indicated China is imposed new restrictions on some Chinese cities because of rising COVID cases. So here we go again. Just like last winter and this spring, China, what? You're going to shut down because you got some COVID going around? That's not going to help our supply chain. That's not really easing any that should have been getting it back on its feet by now. At least that's what common sense might have thought. But no, supply chain problems are still persistent, just like inflation is still persistent and sticky. And now we've got COVID being sticky in China, which is going to hurt manufacturing again. Okay. So more pain to come. Make sure you write that down. I don't think we'll avoid it. Now, notwithstanding all these other issues, the major indices forged a rebound effort today. We looked at it on the 5-minute chart. That's all broad-based participation. And most stocks recoupled losses registered in the opening trade. That rebound, however, like we pointed out, hit a wall this afternoon. The second leg lower today followed the Bank of England's governor, Andrew Bailey, advising pension funds that they only have 3 days left to rebalance their portfolios. 3 days. That's it. And then what? They're going to watch as pension funds fail? If the worst is yet to come? Yeah, I don't think that they will. They'll step in again at some point. When? I don't know. I should have paper traded. What, today? Yeah, this chop in the market today, boy, it will chew you up and hurt you in a very fast second. I have to admit, I got thrown off this afternoon when I was trading myself, and maybe I should have paper traded too. But yeah, the fall this afternoon, it caught me off guard too. I thought this rally effort, I thought maybe we'd get back to, the high of the day, and then maybe that would be it for today, and then we just kind of chill out after it started going down a little bit in the early afternoon. But no, once we hit that wall, boom, it was over. And now we go into PPI tomorrow, so we're going to get some sort of read on inflation tomorrow. And at first, before I started diving into what was happening over in the UK, I thought that maybe the inflation numbers had leaked, and that's why the market just kind of suddenly dropped. But that's also another reason when we hit that wall this afternoon. That's why I sent the note out to our investment community on Patreon and on Discord, just so you'd have an idea of what in the world's going on in case you were out there trying to figure out what was happening. So anyways, back to the Bank of England's governor telling pension funds they've got 3 days left to rebalance, keeping in line with the Bank of England's prior indication that its emergency purchase of gilts would end on October 14th. So mark October 14th in your calendar. That could be an interesting day, because if they stop buying what is essentially bonds in England, what's going to happen on the 15th when they stop? Is their market going to give out at that point? We've got to pay attention to what happens. 14th, they stop buying. What's going to happen on the 15th? So unfortunately, what's happening over there is having an effect over here. Now, no, I meant S. Oh, okay. Gotcha. Took me a second there. Okay, so the fact that the world or the market would trade lower on this news about the Bank of England implies that there was an expectation that the Bank of England would ultimately extend its timeline for purchasing gilts. And when it didn't, that made market participants nervous that, when they stop what is basically emergency quantitative easing, right, to save pension funds, that's the real problem that's happening in the UK right now. Pension funds were about to crash and be destroyed. The Bank of England is trying to save those pension funds from collapsing. That's why they started buying in what we would say is bonds, what they say is gilts. Same thing. It's their bond market. They're trying to save it. So if their bond market is having that much of a problem, oh my gosh. If we had a stock bubble back in the 2000s, if we had a mortgage and housing problem back in 2008, 2009, what is 2023 going to bring us? 2022, 2023. Is that going to be an even bigger market cap? Like our bond market is going to have problems? And what? Implode? That's like kicking the can down the road and creating a bigger and bigger and bigger bubble. Yeah, the stock market, it's pretty darn big. But then you think about the housing market and it's even bigger. And then when you look at the bond market, it's even that much bigger. So have we just blown the bubble and moved it to different places so we could add helium to it? Man, that is a scary thought that I hope doesn't happen. Now, faced with the potential that this emergency support is going to be pulled or stopped relatively soon, the 14th, as indicated, market participants are freaking out about the possibility of some type of market dislocation that could have consequences elsewhere. Now, a bright spot today, well, the Dow Jones. Let's pull this up here. I want to go to the ticker symbol DIA. We don't look at it very often, but that's the ticker that represents the Dow Jones. just like QQQ represents NASDAQ and the SPY represents the S&P 500. Now, it did pick up a gain here today and ended the day in the green, which wasn't too bad. But I mean, come on, it's still down, not the most. It does hold up pretty darn well, but it was able to get 0.1%, very modest gain, but it did outperform from the start as well. And one of the big reasons is the Dow only has 30 stocks. So if one of them does good, then a lot of times that can help pull other ones that are doing poorly up with it. Now, Amgen, ticker symbol is AMGN. It was up 5.7% today, and it's a component in the Dow. And it was upgraded by Morgan Stanley to overweight from equal weight. That helped to pull up the Dow Jones. And we also have to look at small cap. So the IWM, it was basically flat, unchanged today. And the IWM, that's your like Russell 2000, that outperformed the broader market too. Also, the S&P Midcap 400, which are your not your small caps, not your big cap, but these are, right in the middle there, 400 companies, that gained 0.2%. So small caps right now are holding up better on the long side of the trade than the broader market. Let me pull this up here and I want to show you this. Even though we've had some gaps here, maybe there was an island top that we had over here, but look, I'm going to put a trend line on the intraday low from September 27, draw it over to today, and what is that line doing? That line is inclining. It is going up. Interesting, right? Small caps are holding their ground. I find that very fascinating that small caps are doing that. So keep an eye out on small caps. Maybe if we can get a small cap rebound, and again, one of the main reasons why small caps even get a rebound first, besides the broader market, is because small caps are full of companies that are being shorted, right? The float is just completely at a high percentage, 20%, 30% of the float being shorted. So that's why small caps can hold up relatively well when the broader market is still going down. So that's why I like to watch the IWM and trade the IWM. Okay. I should have started trading with a paper account. Yeah, I started trading in the bear market with real money, LOL. Yeah, yesterday it definitely reminded me, and I'm going to mention it more. Paper trading is an important step to take. As a matter of fact, when you first start to think, well, you know what? I want to start being an active investor, not just pouring money into 401k, which, has its own risks. Like, for example, if we go into a period where taxes are rising, okay, you put money into your 401k, it's not taxed, right? When it goes into the 401k. When it comes out of the 401k, your retirement, then it can be taxed. Now, if at the time you are putting money into your 401k and the tax rate is steadily going down, then when you retire, that's wonderful. You'll be paying even less tax than you were when you first put the money in, okay? However, if that's reversed and taxes are on their way up, right? If they've been going up year after year after year, then it may make more sense to, instead of putting money into the 401k, to putting it into a money market account and you being an active investor on it. And again, this is a big picture look at things, and it only is taking into account what the tax rate is and where the tax rate is going. Hope that makes sense. I'm not saying it to overcomplicate things. Sometimes ideas just pop into my head. Okay, so your steps to becoming an active investor or an active trader. Paper trading should be one of the first steps, right? Do your research. Start looking into what is investing, what is trading, what is, being an active investor and trader. And then you go into paper trading. And then from paper trading, you ease your way into actually trading with, like you said, real money. And going in a bear market is very difficult, and you are learning very quick. I guess that's one silver lining and one benefit to going in at a bear market is you do learn very, very quick. Look at 2020. How many people jumped into the investing world because they were at home, had some money from the government, and said, well, let's go trade it. Let's go see how we can do with this. And with the central bank pumping money in, quantitative easing, it was just a jolly good time. It was a bull market. Anybody could make money. It was that simple. You could throw a dart at a board, a monkey could do it, right? And there is that test out there that had a monkey throw darts at, yeah, it did pretty darn good. So just my point is, paper trading, it should be one of the first steps you take when you first have that, I want to give it a try. I want to try to be an active trader, an active investor. Don't skip that part. It's an important learning lesson. Now, in a bull market, things move slower, right? And when you make a mistake, the mistake isn't as costly. When you're in a bear market, things move fast. And really, it's the volatility that make things move fast or seem to move fast. So yeah, don't forget that. And I'll bring it up more and more often. I won't forget that important lesson. Thank you. I traded with real money, lost a lot, learned the hard way. I started at the end of the pandemic run. Yeah, skipping that paper trading aspect of learning how to, it can be a costly one, but it is a lesson learned that you will never forget. And that lesson learned with the real money is a lesson that will not be forgotten. Making the mistake and learning the lesson paper trading, it won't hit you in the gut the same way that real money will. And I guess that's because the stakes are real at that point. You can't avoid it. Okay, so going back to where we were here. Small caps are holding their ground. Why? Because there's a lot of short pressure. Short squeezes are popping off. Whenever we get oversold, we can have more short squeezes, and it can become a cascading effect. And that's what you see with the small caps being flat today, hardly moving at all. This is what you would call a doji candle, where the body of the candle is right in the middle of the wicks, and it's a small body. Now, when we do our trades that go out throughout the week, we include Doji Star, so stocks that have formed a Doji Star. That's one of the strategies that we use with our stocks that can be traded. Now, the Doji Star typically means that there is a stock, ETF, IWM, like you're looking at here, that's usually trading in a wide range, and then all of a sudden it kind of stops, doesn't move. And that's when the Doji Star is created. And it can mean that, all right, this usually moves rather quickly. Why has it stopped all of a sudden? Well, it could be teeing up for another big move. So it's something to pay attention to. Okay, so there we go. So just in case I didn't mention, the SPY was down 0.6%. The Qs were down the biggest, 1.3, 1.4%. IWM flat, and the DIA was up 0.1%. Now look at the Qs right here. Let me open this up and pull it a little closer together so you can see what happened here on the Qs. Now, the Qs did set a new low for 2022 today. Tech got hit. Why? It's the bond market being affected over in the UK. So with worries that what if our bond market implodes? Well, that can put pressure on technology. You've heard it many times before. So yeah, new low of the year, new intraday low for the year. It's just looking like it's coming down here to the lower end of the weekly expected move, which is at 257 right now. It closed at 262. All right, let's look at the sectors for today. Oil, energy stocks, energy sector. We sent out our momentum stocks list, and like I said last week when I talked a lot about it, we don't usually share that on our live streams. We leave that for our private investor community. But this week, I want to say it because it seems odd that we did it. This week, our top 3 momentum stocks from last week are the exact same this week. Some may say, well, that don't make sense. How can you pick energy stocks this week? Energy ran up last week. Isn't it pulling back? Hasn't it pulled back so far, today, yesterday? Well, I want to talk about that. I do. I want to talk about that. So, and I'll get into that in just a moment. With these sectors, right-hand side of your screen here, red and green, there were only 3 stocks that closed in positive territory. Maybe you could count a 5th one. It was rather flat, which would be industrials. They closed down 0.02%. That's pretty much flat. So we could say 5 finished in the green, 3 truly in positive territory. Today, real estate was the winner. It was up 1%. And then on the losing side, though, of the trade, there were bigger losers than winners. Communication services, which is XLC, down 1.87%. Information technology, which is XLK, down over 1.5%. They were at the bottom of the pack today. Okay, let's talk about energy. I want to pull energy up. It was down 0.8%. And I want to talk a little bit about the momentum stocks here. Now, energy, it's got a green candle, but that's just something that TradingView does. It was still down, but from where it opened to where it closed, the candle moved up. Okay, so that's why it gives it a green candle, even though it was a down day. Again, 0.8%. Now, again, not weekly updated weekly expected moves here. I won't do that until tomorrow because I want our private investor community to have that. They get them Sunday evening, and then they can do with that information, use it to their advantage before I do it publicly here. But energy being down today, it bounced almost on its 50-day moving average, but it is above that 5-day moving average. I'm sorry, 50-day moving average. Above, bullish above, bearish below. Okay, so we have that. It is holding above it, which is a positive. Now, I want to look at a couple of things here. Number one, I want to look at XOM, which is Exxon. This was our top momentum stock pick for last week. This is our top momentum stock pick for this week. Now, it ran away last week. It did absolutely amazing, but it got overextended, okay? Overextended, and then we have a pullback. And overextended, I mean, it got really disconnected from that 5-day EMA, okay? So last Friday, we had a pullback of 1%. Yesterday, a pullback of 2.1%. Today, it was a pullback of 0.85%, but when we look here, I'm going to go to the 5-minute chart. Give it just a quick little second. Let me update this. Now, here it is, a gap down this morning, okay? And that gap down took it down here, okay? And if we carried that same line over where the gap down was, we would line up about here, okay? So where it opened at, which was actually down here, to where it closed at, which was up here, it moved up throughout the day. Even though it had this volatile session, it still, when I throw the trend line on that open, I'll go as low as the wick to the opening wick to the closing wick. What's that angle? It's ascending, okay? So that's why the candle is green on TradingView when you look at the daily, even though it was a down day. I just wanted to explain that because I don't think, I'm not sure if everyone knew about that or not, but it's ascending. Even though it's a volatile day, it's ascending. It had this big giant gap down this morning, and then it slowly worked its way up. Now, I do believe at some point, energy will be worth, I don't know, maybe worth a short or two. But it's not right now. I don't think it's right now. I think with oil bouncing and coming back up, I think that's going to be tremendous on these companies. Plus, with these companies, they made a jackpot, right, with profits. And earnings are 17 days away. I think that's going to play into oil companies as well, right? I think they're going to have pretty decent profits again. So ExxonMobil, we can watch it all week and see whether it was the right call or not. And then if you remember from last week, OXY was our number 2. And again, I'm not going to do this every week. I did it last week, and since I kept the top 3 the same, I'll do it again this week. But then that's, I won't keep on doing it. So here we have accidental. So we go back to last Friday, down 1%. Monday, 5.9, nearly 6% drop. And then today, 2.4%. So I think this pullback here has been significant, so much so that it did bounce on its 20-day here, or at least close on it. The wick went below it, pulled right back up. It is below its 50-day, I'll give you that one. But I still think it's got some gas left in the trunk. When I was looking at this last week, I was thinking that maybe that this area here could be where it could finally maybe fizzle out a little bit. So we've got that one at number 2. We can watch it this week and see how it does. And then CVX, okay? That was number 3, Chevron. We'll look at the chart here real quick. These are the top 3 momentum stocks, same from last week. Again, you see the same thing. Lost 1% on Friday, lost 1.8% on Monday, and today it was flat. Closed above its 50-day moving average, which is real nice. Bounced the wick here, bounced off its 20-day. All right, so we got that. All right, let's keep moving on. Let's look at the Treasury market because obviously it was closed yesterday, open today. Let's start with the 10-year. US 10Y is the ticker to use. Now, the 10-year Treasury yield rose 6 basis points today at 3.94%. It hit 4% overnight. 4% overnight. It is cooling a bit. 6 basis points, not a big move like we're used to seeing or like it has been over the past few months. But like I said yesterday, when the Treasury market was closed, that it was disconnected from its 5-day EMA. And what did I say it was most likely going to do? Reconnect with that 5-day EMA, and that's exactly what happened. The wick came down, touched that, reconnected with the 5-day EMA, and then moved back up. So that circuit board, the circuit was complete. It touched it. It is there. Now, not a big move, so not much to talk about. Let's go to US 02Y, which is your 2-year. Now, the 2-year was even more less dramatic. It was unchanged on the day at 4.3%. Tenth of a percent, almost 0.2% higher in the after hours, however. Okay. Oh, I should have talked about this when I was talking about energy. Let's look at oil real quick. U.S. oil. I totally forgot about that. Energy complex with all of your different oil, natural gas, etc. It was really mixed today, right? But with crude oil futures, they fell 1.9%, just as we talked about yesterday. It was disconnected from that 5-day EMA, which is a very short-term moving average. So whenever something gets disconnected from it, you can expect within the next day, 2 at the most, for it to reconnect. And that's exactly what oil did here. Got overextended, reconnected with that 5-day EMA. It closed at $89.18 a barrel today. It's down a little bit more in the after hours. I'm watching that 50-day moving average to see if it can bounce off of that. Now, when I sent out the momentum stocks list to our private investor community, I put a special note there about oil and why I'm choosing energy stocks again. So if you haven't read that note yet, please do so. It'll give you a little insight on oil, specifically on oil. And that's on Patreon and Discord. Click the first link in the description and it will take you there. Now, today's economic data was limited to the September NFIB Small Business Optimism Index, and surprisingly, it actually went up. It was at 91.8 in August. It rose to 92.1 in September. Not a big move, but it did go in positive direction, which is odd, right? Because it seems like everybody's bullish. I mean, bearish right now. All right. Looking ahead to Wednesday, which is tomorrow. Market participants will receive the weekly MBA Mortgage Application Index. That was a big shocker last week. It was down 14.2%, but that comes out at 7 a.m. Eastern. And then the September PPI, Producer Price Index, that drops in the morning. The expectation is 0.2%. Again, the expectation for the PPI, Producer Price Index, is 0.2%. The prior reading was a negative 0.1%. And then we have Core Producer Price Index. The expectation is 0.3%. The prior reading was 0.4%. Because remember, last month we had a tick up in core inflation. So we're expecting then it to tick down this coming report. Okay, that comes out at 8:30 a.m. It will have an effect on the market. And then in the afternoon, we're going to have something else that is going to affect the market. And it could be a positive way, it could be a negative way. But we get the FOMC minutes for the September meeting. That comes out at 2 p.m. Eastern. So just like today, I'll go use the SPY for this example. But just like today, in the afternoon trade, I'm going to go to the 5-minute chart here for the SPY. We hit that brick wall, right? That brick wall this afternoon in the SPY, right here. This sell-off right there, okay? We could have something very similar happen, but it's either going to do this or it's going to go in the opposite direction when the FOMC minutes are out. That's where we get to see how the Fed was thinking, what they were talking about during the September FOMC meeting. Okay? Are they talking privately and being more optimistic about inflation going down? Or are they talking even more hawkish than they are publicly about inflation being sticky and being hard to bring down? What about rate hikes? Are they still considering 75 in November and 75 in December, bringing the Fed funds rate up over 4% at the end of the year? So there'll be some interesting notes in that release, and it will have an effect on the market. If the market believes that rate hikes are still coming, then the market's liable to go down. If within the minutes, the market believes the Fed is going to take a softer approach when it comes to rate hikes, then the market is likely going to cheer that on. And right now, with where the market is headed, let's go to the daily review here on the SPY. And let's look at this. Right now, we've got an RSI of 37. You would think that since the SPY hit a new record intraday low for the year today, that maybe, just maybe, relative strength would be weaker than it is. But it's not. Remember, and let me get the Sharpie out here. Remember, when RSI bottomed right here, the most recent time, my line's just a little bit off. Let's see, can I move? There we go. Right there. RSI dropped down to a 22, okay? And that was a few days. I mean, it was actually on an update here of nearly 2%. If that happened here when the market had not made a new low for the year yet, and then a couple days later, the RSI was actually, instead of at a 22, it was at a 27 when we made a new close, a new low for the SPY this year of 157. You would have thought that, oh, well, RSI must have been weaker. No. RSI can come in weak a couple of days before it drops to a new low. RSI can actually be ticking up. It just depends on how price action has been moving. Price action was moving sideways before that new low. Right now, price action is kind of moving in a downwards direction. So the RSI is also moving in a downwards direction. But today, with it being at a 37, I mean, we have more room that we can go down before this RSI gets to an oversold reading. So just keep that in mind. Just because the RSI is still at a 37, you think, oh, well, it's getting close. We must be getting to an oversold point. Technically, you got to get to 30 or below for it to be oversold. And we're just not there yet. We could go down and touch this weekly expected move down here at 350 on the SPY and still not be oversold. It may look like it with price action, but with relative strength, not quite there yet. But it would be getting close once we got that far. So I'm just pointing that out. Even though RSI is at a 37 right now, there is still more room for it to go down before it hits. Maybe we make a couple new lows day after day. Maybe we make a new low tomorrow and a new low on Thursday. It all depends on what inflation is going to be at. Okay? So inflation is the name of the game. It has been for the majority of the year, along with what the Fed's doing. So tomorrow we get producer price index, which typically doesn't have as much weight as with the consumer price index. But on Thursday, when we get CPI, tomorrow when we get the PPI, we get the Fed minutes tomorrow afternoon. The one thing you can count on is volatility, okay? Volatility will be increasing. We're not going to get rid of it as we move into the end of this week, right? I mean, look at this. It has just been on a war path for the past few sessions. Just boom. And it's not going to get any better. Not with the data that's coming out over the next 3 sessions. Don't forget, we've got bank earnings. And bank earnings have information within them that speak about the consumer, okay? So keep that on your minds. Okay, and let me just say this as I'm putting this comment up here. I've reached the end of my notes for today. So now is the perfect time to ask questions if you have any before I wrap up the live stream. But if you could do me a quick favor while you were doing that, if you could click the like button and share this video with a friend, that would be very, very helpful to this channel. And if you like the perspective, you want our weekly expected moves, our numerous trade setups, our top 10 stocks list, our top 10 momentum stocks list, insights on economic data and on the market, then click the first link in the description and you'll get instant access. So greatly appreciate that one as well. Okay, let's talk about this here real quick. I'll take this back over to the SPX. Go to SPX here. I'll look at AMD. Let's go with this question here right quick. Do you plan on trading tomorrow? I feel like it's going to be all over the place. Yes, I do plan to trade tomorrow. My plan tomorrow is to see what the information looks like in the morning and see how the market is acting in the morning. I have no open positions as of right now, and I will not until I can judge what the market is going to do. And what I'll probably do is just make a quick trade in the morning. I would not leave it open anywhere past the lunch hour. Typically when you get to the lunch hour on the East Coast, 12 o'clock to 1 o'clock, the market kind of slows down a little bit. I'm probably going to be done and not have any other trades the rest of the day because I don't know where those Fed minutes are going to take this market. because it's going to be a psychological move tomorrow afternoon. There probably won't be any logic in how the market moves. At least tomorrow morning, there is clear data that will move the market. But tomorrow afternoon, it's all about how you interpret the Fed's minutes. It's just like when the Fed and Jerome Powell on FOMC days, when rates get raised or lowered, when the press release comes out at 2 and at 2:30 when Jerome Powell comes out and speaks, the market can have big swings up and big swings down and right back up again. It's all based on how you are interpreting the information. The market hasn't had any time to digest the information yet. So that's how tomorrow afternoon will most likely play out. However you interpret it, the collective of the market, that's how it'll move. But tomorrow morning, we do have some real data that we can use to help decide which way the market is going. And then, so yeah, tomorrow afternoon probably 99% won't have a trade at all tomorrow afternoon. And then on Thursday, when we get our CPI report, I guess some of it is going to depend. Well, number one, I won't have any open positions, just like right now, going into the CPI report. Okay. So whether the market, gaps down in the morning or gaps up, whatever the case may be, I'm going to miss that gap, but that's fine. There'll be plenty left to get after the report comes out. So just like tomorrow, nothing opened right now. It'll all depend on what the data says tomorrow morning. So that's that. And then AMD and Walmart. All right, let's go ahead and do this right quick. And let's see here. We'll throw this up. Walmart is WMT is the ticker for Walmart. And let that load. Open this up. Boy, Walmart had a nice day. Up 2.6%. Let's see if they got. Walmart launches project. When was this? 9 hours ago, to boost access to healthcare and research. Walmart to compete with Walgreens, CVS in recruiting clinical trial subjects. Amazon Prime Day like event kickstarts holiday. I don't know how that's got anything to do with Walmart. So today's news on Walmart is it looks like a healthcare related move. Let's see what that says there. Okay, so a couple of things today outside of this healthcare research project that Walmart launched. I mean, there's really nothing here about it. It looks like the bigger reason, and it's not out here on TradingView publicly, but it looks like why Walmart Plus could be worth $45 billion from Morgan Stanley. So Morgan Stanley put out a piece this morning at 10:30 talking about Walmart Plus memberships at a record about 18.5 million after increasing 2 million in September, the largest quarter-over-quarter increase since August of 21. Addition of Paramount Plus likely having an impact. Disclosing Walmart Plus membership could be a positive catalyst for Walmart. Standalone value could be about $45 billion. Let's see, what else do they have to say that's important here? So it looks like the membership TAM, or total addressable market, that's what TAM stands for, which Morgan Stanley defines as current members plus very likely to subscribe members, discounted by 25%, was about 27 million. And remember, they've got 18.5 million right now. Also a positive inflection, 3+ million, and a new record. So Morgan Stanley basically came out at 10:30 this morning with a piece that said the membership of Walmart, the total addressable market could be about 27 million, and they're at 18.5 million right now, and it could be worth 45 billion standalone. Walmart Plus only being worth 45 billion. So that's a pretty big deal right there. Now, of course, last week, Walmart came out and announced that it is eliminating 1,500 jobs from Atlanta. So they're going right along with the job cuts as well. And then before that, again last week, Costco's monthly bump could be a positive for Walmart. So that's why Walmart was up 2.6% today. All because of a note from Morgan Stanley saying Walmart Plus is worth $45 billion by itself, and the total addressable market is probably around 27 million when they're only at 18.5 million members right now. So that's it for Walmart. I like Walmart. I think it's a good long-term investment. Obviously, this thing has been all over the place. Let's fix this chart here. I mean, giant drop from earnings 2 quarters ago and a giant boost from earnings last quarter, but it is trending down since last quarter. You can see that with this trend line right here. Let's fix that. Change that to red. So it is in a downtrend leading up to earnings here, but it's still ways away, 34 days. So got a month to go there. Overall, in 2022, as we look at this, man, just that one giant fall there. What was that, a 3-day event of just steady falling? Wow. They fell 11.4%, 6.8%, and 2.8%, 3 days in a row. That was gigantic. Then we put another trend line on here because this is interesting. If we go from that bottom that was made there up to where we are now, that'll be an interesting trend line to see if it can, if it gets broken or not. Not make them so big. Okay, so that's what happened with Walmart today. Let's look at AMD. I did not check in on AMD today. I should have. To see whether they kept falling. Yesterday, they were down another 1.1%. So down 1/3%. They've slowed down there. That's a plus. That's good that they've slowed down. All right, let's open this up here. Now, if AMD could somehow start building a base right here, that would be positive after all this falling that it's been doing. But it's definitely in a good little spot here. All right, let's see how it looked here on the 5-minute chart. Oh, it's not too bad. That's not too bad at all. So from its low this morning, we go to, we catch this bounce here. Just for the day, that's an ascending trend line there. You don't want that to be red. That's support. So that's a bonus right there. And even yesterday during the day, which one of these are the lowest? It looks like this one right here. So if we catch those two support, that's ascending. So it looks like AMD here is finally starting to hit the brakes after the damage that was caused last Friday. It looks like that damage could be slowing. And it looks like investors are finally starting to maybe want to catch a bid here on AMD. Both yesterday and today, both during the day, it is ascending. So if we can get a follow through where we're not selling off or gapping down first thing in the morning, then that could be a nice little bonus there for AMD. But this looks really nice. This looks like after significant falls where we could potentially be seeing a basing out here, or what I talk about often with expansion and contraction, right? So we just came out of major expansion down. So now we're going to start contracting and maybe even just moving sideways there before we start expanding again. So this could be a little quiet period here for AMD. 21 days still away from any other earnings coming out. So that's positive right there. After that huge fall down, that is positive. in my view. AMD, please. I'm holding some options overnight and I'm scared. Yeah, I'll definitely say that with these 2 ascending days in a row, that is a positive. Holding them overnight is interesting. Although producer price index probably won't play a huge role on a company like AMD. The producer price index doesn't typically move the market all that much because the producer price index is very focused on producers. And especially in the S&P 500, you've got 11 different sectors. Some of them don't relate as directly to the producer as others do. So you've got that on your side. We'll see how it does. Obviously, tomorrow could be a nothing day with just more volatility as usual leading up to CPI. Because most market participants don't really pay attention to what the producer price index is about. It's the CPI report. That's the big one, right? That everybody knows. It's what'll show up in the headlines of the newspapers. While the producer price index, it's not really a newspaper headlining number that you'll see on mainstream media. Now, if it's a finance specific show you're watching, sure, they'll talk about it. But overall, it doesn't have the same effect relative to the consumer price index. So we've got that going. All right. Anything else, or we can wrap this up until tomorrow. If we are wrapping it up, if you're good on your questions, that's cool. Our investor community, you'll get some updates about the producer price index. So expect those. And we'll be back live tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. You are welcome 100%. So I guess that's it. We'll wrap it up here. Thank you, ladies and gentlemen, for joining me this evening. I greatly appreciate your time and attention. If you could please click that like button and share this video with a friend. If you want more of this perspective, then click the first link in the description, and I think you'll find something there to help you along your investor journey. All right. Well, good night. Have a wonderful day. You are welcome. And we'll be back tomorrow. Want to get that up there real quick. And after it is there. Beautiful. Awesome. You are welcome. Every one of you. So have a good night. And I'll talk to you and see you tomorrow. Take care.